Welcome to Kalkine's educational series. Today, we are talking about initial public offerings or the IPOs. So what's an IPO? An IPO is a process by which a private company offers its shares to the public for the first time, allowing it to raise capital from public investors. An IPO marks the transition of a company from a privately held entity to a publicly traded one with its shares listed on a stock exchange. Let's talk about the key aspects of an IPO. First, the purpose of an IPO. It's really important for raising capital. Companies go public to raise capital that can be used for various purposes, such as expanding operations, paying off debts, funding research and developments, or acquiring other companies. Secondly, it's important for liquidity for founders and early investors. An IPO provides an opportunity for the company's founders, early investors, and employees to sell off their shares and realize gains from their investments. Thirdly, it's really important for brand visibility and credibility. Being a publicly traded company often enhances a company's visibility, brand recognition, and credibility in the market. Now let's talk about the process of an IPO. First, preparation. The company hires investment banks to guide them through the IPO process. The company also prepares financial statements, disclosures, and regulatory filings, including the registration statement, usually which is the Form S1, with the Securities and Exchange Commission in the US. Second, valuation and pricing. The underwriters work with the company to determine the IPO price, which is the price at which the company's shares will be offered to the public. This involves assessing the company's financial health, market conditions, and investor demand. Third is the roadshow. The company and its underwriters conduct a roadshow where they present the investment opportunity to the institutional investors to gauge interest and secure commitments. Fourth, going public. On the IPO date, the company's shares are made available for purchase on the stock exchange. The shares begin trading in the open market where their prices may fluctuate based on supply and demand. Now let's come to the type of IPOs. First, traditional IPO. In a traditional IPO, underwriters help price the shares, sell them to institutional investors, and stabilize the stock price after the IPO. Next, we have the direct listing. In a direct listing, the company does not issue new shares or raise new capital, but it allows existing shareholders to sell their shares directly to the public. This method is typically used by companies that do not need additional fundings or want to avoid underwriter fees. And then we have the Dutch auction. In a Dutch auction IPO, investors place bids for shares at various prices, and the final offering price is determined based on the highest price at which all the shares can be sold. Now let's talk about the advantages of an IPO. First, access to capital. An IPO provides access to large amount of capital that can be used for growth and expansion. Second, we have the increased public profile. Being publicly traded can enhance a company's profile, attract more customers, and make it easier to attract top talent. Then we have the liquidity. An IPO creates a public market for the company's shares, providing liquidity for early investors and employees with stock options. Next, it's the currency for acquisitions. Publicly traded shares can be used as currency for acquisition, allowing the company to grow through mergers and acquisitions. Along with the advantages, now let's talk about the disadvantages of IPO. First, regulatory requirements. Public companies are subject to stringent regulatory requirements, including regular financial reporting, governance standards, and disclosure obligations, which can be costly and time-consuming. The second disadvantage would be the market pressure. Public companies face pressure from shareholders and analysts to meet quarterly earnings expectation, which can lead to short-term decision-making. Loss of control is another disadvantage. Founders and early investors may lose some control over the company as new shareholders, including institutional investors, gain influence. Next, we have costs. The IPO process is expensive with significant fees paid to the underwriters, legal advisors, and accountants. Now let's talk about after the IPO listing. First, stock performance. After the IPO, the company's stock performance depends on various factors, including market conditions, the company's financial health, and investors' sentiments. Then we have the ongoing reporting. Public companies must file quarterly and annual reports with the SEC and adhere to strict governance and transparency standards. Then we have the shareholder relations. The company must manage relationships with its new shareholders, including institutional investors and retail investors, balancing their interest with long-term business goals. So an IPO is a significant milestone for a company, marking its transition from a private to a public entity. While it offers opportunities for raising capital, enhancing visibility, and providing liquidity to early investors, it also comes with challenges such as a regulatory burden, market pressures, and costs. Companies must carefully consider the timing, structure, and implications of an IPO to ensure it aligns with their long-term objectives. Thank you for watching. For more related videos, please subscribe to our channel and press the bell icon.